This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
Welcome to the Creating Wealth Show with Jason Hartman. You're about to learn a new slant on investing, some exciting techniques, and fresh new approaches to the world's most historically proven asset class that will enable you to create more wealth and freedom than you ever thought possible. Jason is a genuine self-made multimillionaire who's actually been there and done it. He's a successful investor, lender, developer, and entrepreneur who's owned properties in 11 states, had hundreds of tenants, and been involved in thousands of real estate transactions. This program will help you follow in Jason's footsteps on the road to your financial independence day. You really can do it. And now, here's your host, Jason Hartman, with the complete solution for real estate investors.
Welcome to episode 1862, and today we have Joseph Wang back on the show to talk about Central Banking 101 and his work at the Fed. This is likely the guest on any show who has the absolute record for trading more assets in dollar value than maybe anybody else in the world because he ran the trading desk at the Federal Reserve. And wow, they have got to be the largest investor in the world, right? They shouldn't be, but hey, it's not a perfect world. We have a centrally planned economy. We have what we have. And as you know, my philosophy is always align your interest with these big powers, the two most powerful forces the human race has ever known, governments and central banks. Okay, before we get to Joseph, let me share a couple of things with you here. First of all, housing inventory. It's going up. It's going up. Okay, so we have a 6.2% increase from last week. This is pretty significant. I've got some data here from our friends at Altos, and we are getting Mike back on the show, hopefully soon. He was on before, and we'll take a deeper dive and get some of his opinions and thoughts on these numbers. But right now, we stand at an inventory that is still overall historically very low, but it is trending up with these higher interest rates. 444,000 homes for sale in the US in terms of the 7-day average. But when you look at the 90-day average, and you can see that on the chart if you're watching on video, by the way, if you're listening to the podcast, it's always a great idea to simply refer to the YouTube so you can see the video and see the charts and graphs. And actually, I got one more thing for you. I didn't mention this, but I'm going to let you in on a little insider thing. We are really trying to do a much better job of sharing our slide decks with you. And, you know, I've been on a whole bunch of speaking engagements lately. For every speaking engagement, I update my slides, I tweak them, I talk about different stuff, I take slides out, I put new slides in. And if you are not one of our sleazy competitors who is stealing our ideas, yeah, that means you sleazy competitors out there, then you are welcome to go and download several of my slide decks at jasonhartman.com/slides. And I'm sure some of you sleazy competitors will fake that. And don't worry, I'll see when you're out there using my stuff and not providing proper attribution. The world is full of sleazy tricksters, isn't it, folks? There's just too many of them. But anyway, go to jasonhartman.com/slides and you can get some of my recent slide decks there for you. It won't contain this, but this may show up in there someday. Anyway, the 90-day average, though, in terms of inventory levels, 330,000 homes. So you can definitely see how inventory is increasing, but we are still way below the necessary inventory to have just a normal market. We're way below it. We still need to see inventory increase by, and I used to say 300 to 500%, but I'm going to change that now because inventory has increased. We need to see inventory increase by about 250 to 400% to be at normal levels, and that only gets us to normal. It doesn't get us to a buyer's market or a down market. Supply is still extremely low, but it is moving up, and we'll continue to watch it. However, remember, I've taught you about how it depends on the price range. And when you segment by price, this gets really interesting. So let's take a look at this chart, and you can see that the higher priced homes, when you look at higher priced homes, okay, don't worry about lot size or square footage or any of that too much. I just want you to look over here at price, okay? The median price, when you segment it in the marketplace into 4 parts. The median price of $180,000. Now remember, median and average are different things. And I've always kind of wondered if it's better to use the median price than the average price. The statisticians like the median. I'm not so convinced that that's the right way to do it, because all you do is you look at all the prices and you pick the one in the middle. You got the median price. I don't know. Maybe they should average them out, but of course they're concerned about, not having weighted averages. So if one super high-end home or one super cheap home is on the market, then it's going to skew everything. But when you divide it into the 4 quarter segments here, I'm not so sure. But whatever, it is what it is, okay? So median price of $180,000, you can see that you had 22,480 new homes hit the market, but the number absorbed was 23,180. That means more properties are being absorbed, in other words, purchased. That's the drain in the bottom of the sink. Remember, I showed you that before, that graphic. And then are coming on the market or for sale, right? So this inventory is declining. That's the important point. That's the important point. Did you hear that? The inventory of the entry-level homes is declining. Well, the broad overall inventory of all homes for sale is increasing. That's why it's very important to peel back the layers of the onion so you know what's really going on. Because, of course, if you're listening to this show, you're probably an investor or you're interested in investing. And, of course, the properties you're investing in are these entry-level homes. Now, remember, these are nationwide numbers. So again, you got to allow for some price differences there. Now, if you go to the next quartile and we see the median price of $370,000, of course, for those of you watching, I'm rounding off. It's $369,900, but I'm rounding off. Okay. You see that we added 24,628 houses to the market and absorbed 22,338. And look at these days on market numbers, folks. They are extremely low. Only 21 days on market. This is still a market suffering from a massive inventory shortage. Increasing a little, but very short. But then when you get to the higher end homes, you see that becomes more imbalanced in favor of the buyer, because a lot more homes are coming on the market than are being absorbed. In other words, those are being absorbed more slowly, but they're being listed more quickly. I hope this helps you really realize that this whole inventory picture for investment properties, for rental property price ranges, there's still a massive supply shortage, and the inventory is declining, not increasing, declining, at least for now. It's subject to change without notice. Well, actually, you will get notice because you'll be following the show, and hopefully you'll be watching on YouTube so you can see the video. You'll download the slide decks at jasonhartman.com/slides, and you will be, of course, listening to the Creating Wealth podcast. Okay, now I have an announcement. We have our weekly giveaway of 2 $50 Amazon gift cards. And by the way, I want to show you in just a moment here after we do this about how the whole economy is smoke and mirrors. It's built on a house of cards. We're going to see that in just a moment before we get to our guest. But the announcement about this giveaway, this weekly giveaway that we've been running for a long time is, hey, we're getting bored. Yeah, we're getting bored. So this will be the last week of this giveaway for a little while. We're going to put it on pause here because, hey, you're costing us a lot of money giving away $100 a week. Nah, that's not the problem. We're just going to design something new for you to keep the interest, keep you stimulated and going. And it might involve some other platforms and other things, okay? But the winners for last week here for the YouTube comments, just go on YouTube, make any comment, is Politicracked Podcast. Okay, you are a winner for your comment on the 2.999er here. Feel incredibly okay. So anyway, yeah, whatever that says. I can't read it behind my screen. And then we have got Isaac Wells, who won for the Apple Podcast Review. Go, Jason. Thanks for all the knowledge you've shared since the start of the pandemic. Well, hey, I was doing it way before then, so be sure you listen to the older shows and be sure you catch all our Flashback Fridays. Do not miss Flashback Friday, folks. Well, if you do miss it at your own peril, because those who do not have a sense of history are doomed to repeat it. That's why you must listen to Flashback Friday. Okay, very important. Anyway, congratulations. Go to jasonhartman.com/ask and claim your prize. jasonhartman.com/ask. So I have proof again that the economy is built on smoke and mirrors, on a house of cards. Check this out. This comes to us from our prior show guest, Richard Duncan, who's been on several times. And this chart is fascinating. He just published it. It is total credit in millions in the US from 1951 to 2022. And what this shows is that we have now 90 trillion, that's with a T, $90 trillion of outstanding credit. Now remember, in fractional reserve lending, fractional reserve banking, in the smoke and mirrors economy we have, you've heard me say it a zillion times on prior episodes, that it is hard to get your head around this, but it is very important to understand that money is lent into existence. Money is lent into existence. With the absolutely crackpot setup we have, that's how money is created. So when you create more credit, you create more money. And technically, we shouldn't even call it money. We should call it currency, because that's what it is. It's not money. In my thinking, money is something that has intrinsic value. Fiat currency does not have intrinsic value. It does have value, especially US dollars, because it is backed by the largest military the human race has ever known, and a whole bunch of other things that I've explained on prior episodes. But just looking at this chart, fathom the idea that in just 58 years, there has been a 90-fold increase in credit. A 90-fold. We went from $1 trillion to $90 trillion in credit. Now, the doom and gloomers, the Peter Schiffs, the Harry Dents, the other survivalist type people, they will all say, this is the end of the world. It's all going to crash. And they might be right. But so far, they've been extremely wrong. Why? Why is that? Because nobody knows how much credit we can withstand. Nobody knows how much deficit we can withstand, or how much national debt we can withstand. Look, the question is always, hey, you know the question, compared to what? That is always the question. The Jason Hartman question, as you've dubbed it. Thank you for dubbing it my question. I only wish I actually invented it. But compared to what? Compared to what is the question? Compared to we've never been here before. That's one thing to compare it to. And we don't know, maybe we can withstand $300 trillion in credit, maybe $700 trillion in credit. Nobody knows the answer because we've never been here before. But then the other compared to what question is compared to what other country? Compared to what other country? Who's better off? We're the only one with the world's reserve currency here in the States. And I know we've got an international audience with listeners. Thank you, listeners, for listening in 189 countries worldwide. I'm so grateful that you're all listening to this. And you might think, well, Jason, talk about some of these other countries, not just the US. Well, I certainly talk about the big ones. But look, the big ones have so much sway in the world economy that's what matters. That's what you got to talk about. So the US is number one, China's number two, Japan's number three, et cetera, et cetera. You go down the list, right? But these are the biggest economies that are pushing most of the activity around and most of the, you could call it toxic debt, right? But nobody knows how far it can go. And, everybody was sounding the alarm bells when the debt to GDP ratio was 30%. And then 50% and 60% and 70% and 100%. We blew past all of that. And it's still moving. Japan's debt to GDP is what, like 230%? And it has suffered, but it's got the demographic problem. It's got the people just opting out of life problem, especially men in Japan. Really sad story, but nobody knows how far it can go. There is no answer. There is no compared to what. So that's the thing I'd encourage you to keep in mind when you listen to the people talking about how the sky is falling, because they don't know at what number the sky falls. None of them know. Nobody knows that answer. This could be kicked down the road for another 50 years, another 100 years. Nobody knows. Maybe another millennia. Who knows? The answer is nobody knows. So we will see. All right, let's get to Joseph, who is back with us today. And here we go.
But that's a trade-off to fighting inflation. And if you're not willing to make it, if those are your politics, then we're going to have inflation continue because without some kind of recession, higher unemployment, it's really hard to see this inflation going away.
Well, that's the old Phillips curve debate, right? What do they do? But frankly, we could afford higher unemployment, maybe more easily than we can afford much more inflation. And I'm just speaking as, most people, right? How most people are affected, the broad population. But, one interesting component of it is government debt. The government owes a lot of money and likes to keep spending. So when you look at government debt, aren't they digging their own grave in a way by making their own debt service much more expensive?
So you're exactly right. But the crazy thing is government doesn't really care about that because they have a magic money printer, right?
Right.
So
they have MMT.
No, that's exactly, that actually is how the government operates. You just look at COVID, right? So they spent a couple $1 trillion, and where did the money come from? They just printed it. Now, there's something special about the US Treasury market that I'm not sure most people are aware of. And that is, when you think about it, treasuries are kind of like a form of money. So you have a $100 bill, it's printed by the US government, right? But if you have $100 in treasuries, it's also printed by the US government. It's also very liquid. You could sell it instantly, and it actually pays interest. So in a way, from a very high level, treasuries are basically a form of money. This is actually how a lot of institutional investors think, because if you have $1 billion, you can't put it on deposit at a bank. The bank might go bust. What you do is you hold it in treasuries. So government debt is a form of money. So when you see massive deficits, that's just them paying by printing money. So public debt is really not a problem. The problem is inflation. If you print a lot of money and you go and you buy goods and services like what they did in 2020, you're going to get inflation. It's just common sense. And the trajectory seems to be that we'll just continue doing this. In the future, we're going to have to do more of it because we have to pay for things like Medicare, Social Security. It looks like we're going to have to pay for free college too. So,
yeah, right,
yeah.
right. And bailing out Social Security too. It's interesting to hear the sort of, I'll call them old school kind of conservative thinkers when it comes to monetary and fiscal policy that keep talking about how bad the debt is. And I've been hearing that since the people that sort of grew out of the 70s, like Howard Ruff. I don't even know if you know that name, but they've all been talking about the doom and gloom of the debt, right? The government debt. And the reality is none of them, not Peter Schiff, not any of them, none of them know how much debt a country that has the reserve currency of the world can afford to have. Maybe the debt to GDP ratio can be 2,000%. I don't know. Nobody does, right? We've never been here before. Is there an answer to that? Everybody keep predicting all this collapse, dollar collapse, and I just think they're just wrong. And they've been wrong so far, but they sure do get a lot of press.
They've been
I guess
so wrong.
maybe I'm just envious of all the press they get, and I don't get it. But yeah,
you can start saying it too.
Yeah.
So I think the problem is that people misunderstand how we've moved from a gold standard to a fiat standard since the 1970s. So when you're on the gold standard, you actually can have too much debt and you can default because you don't have any gold. So then you can actually have like a serious calamity, like they're mentioning. But what they get wrong is that we're not on a gold standard anymore. And so a lot of economic theory and monetary theory has to be reinterpreted in that light. When you have the magic printer, then you can never default. So default is never a problem. You can carry debt infinitely because you can just print to pay it. The problem always has to be inflation. And eventually we're going to get to a point where that becomes a serious problem. Actually, we're probably already there. So the policies that you'd have to be careful looking forward to is higher interest rates. We see that already, and that's easy to see because the Fed is fast at acting. But the second part, what you have to be mindful of is higher taxes, because that's the second tool in taming inflation. Now, Congress is disorganized, so we won't get that for right away, but eventually that's going to be part of the toolkit. So I think that's what everyone should be mindful of as well.
Right, but the argument by those people that keep arguing that this inevitable collapse is coming is that other countries will stop buying our debt. And when they do, we're over. It's over. And they will stop believing in the dollar and stop using it as the reserve currency. What do you say to that? Those two things?
If they don't buy it, the Fed will buy all of it. And the Fed has been buying a lot of it the past 2 months. So that seems to work out just fine. So I think it's helpful to understand why other countries have been buying dollars. So the way that the global trade works is that it's actually on a dollar-based system. So if you're Japan and you're importing or exporting something to Korea or something like that, you are actually paying in dollars and receiving in dollars for what you sell. So everyone holds dollars in the world because the dollar is the currency of global trade. Now, if you are a foreigner and you're in global trade, you have dollars and you just kind of had to put it somewhere. So people put it in treasuries as a safe place to put dollars. It's not because they have confidence in the US, it's simply because it's kind of like a network effect. It's like MasterCard or Visa. Everyone runs on dollars.
Well, and what's interesting, just to add to that, and no one really knows the number here, but so do actual people, just private citizens in these other countries. They store their wealth in dollars too, many times, quite literally under their mattress, many of them. They all want dollars because they don't trust their own currency, whether it be Argentina certainly is a great example or whatever, right? A lot of them store whatever dollars they can get a hold of as well.
Exactly. There's actually a study by the Fed about currency in the US. This may be surprising, but the most printed currency is actually in the form just of $100 bills. And you rarely see a $100 bill on the street, right? It's like a 10 or 20. And the estimate is that most of those $100 bills are held abroad and probably either in the cartel or by, let's say, people in Argentina or other countries escaping high inflation. So it does play a role as a store of value for private citizens, like you mentioned.
Yep. And I bet a lot of Turkish people are doing that too. Anyway, just to finish on, what do you say to those two things? Number one is the argument is they'll revolt against the dollar as the currency of trade, as the reserve currency. They'll just stop doing it. And there certainly is some nibbling around the edges, right? Especially with the Russia fiasco. Now there's some trading outside of the dollar, right? Global trade, but it's so minor. I mean, what do you think? Is that a real threat to the dollar?
I don't think it's a real threat. I think there's a trend going forward that there will be people trying to build alternative arrangements outside the dollar. And the reason being, as you mentioned, the Russian fiasco, the West basically confiscated the money held by the Russian sovereign bank, central bank. And a lot of countries, if you're China, if you're Russia, if you're India, you don't want people to just take your money. That's a national security issue. So they're going to find a way to get out of this dilemma. It's going to be very hard. But if you're worrying about the collapse of the dollar, I wouldn't really worry about it collapsing against other currencies. I would worry about it collapsing against goods and services, which is to say inflation. So we could have high inflation and, people could still use the dollar. Strange as it may sound, it's happening right now. So I don't really worry about the dollar collapsing anytime. Throughout history, there are always regime changes in global trade. Before the dollar, there was the British pound, and before that, it was, the Netherlands. Eventually, it's going to shift as well. That happens over a long time period. So.
Yeah, I agree with you. I couldn't agree more. I think the dollar is going to last for a very long time, but nothing lasts forever.
Nothing lasts forever.
Does it surprise you, and I don't know, Joseph, if you follow the cryptocurrency market at all, but I'm certain at the very least you've read the headlines. Does it surprise you that crypto has just had a bloodbath? I mean, we have inflation. Isn't this supposed to be the hedge against inflation? And isn't gold supposed to be the hedge against inflation? And gold does almost nothing. Like why not?
That's a really good question. Well,
any thoughts?
For crypto, it's obvious, right? I always thought crypto, the use case for crypto primarily was that it made the people who got in first rich. Other than that, it's hard to see too much of a use case. That doesn't surprise me. I think many people look at that and think about the dot-com bust, and it looks like they were right so far. It does seem like there's a huge implosion there. For gold, though, I think the difference is that we have a generational shift in what money is. If you think back a generation ago, for a long time, we were on the gold standard. Gold was money. So when you see inflation, you instinctively grab for gold. I'm not sure the newer generation thinks of the world the same way. So if you're looking for a hedge for inflation, it's probably going to be the things that will, first of all, real assets, obviously, but the things that are in need. So energy, for example, commodities, let's say aluminum, green metals, you want to bet on policy mistakes, and policy mistakes are in part responsible for our inflation. That's underinvestment in fossil fuels and the idea to double down on green. So if you were worried about inflation, I would buy fossil fuels and green metals. But things like gold and cryptocurrencies, they haven't worked in the past couple of years when we had tremendous inflation. So it seems like that's just not how the world works, even though in theory, it could plausibly make sense.
Yeah. All right. Talk to us, Joseph, about the Fed itself. And I don't know how much you can say. Obviously, it's your former employer, but we've certainly done many, many shows about the conspiracy theories. G. Edward Griffin has been on several times. I'm sure you know his famous book, The Creature from Jekyll Island. I actually, a few years ago, took my mastermind group to Jekyll Island, and we had our meeting, our retreat there. Our meeting was in the Federal Reserve room.
Oh, that's awesome.
Yeah, I was just wanted to get a history lesson there. And by the way, that's a beautiful place, Jekyll Island, Georgia. What don't people know about the Fed that you're able to share with us? The shadow banking world, just anything.
I think the number one mistake people make about the Fed is just misunderstanding their competence and their intentions. So, there is no grand conspiracy, no man behind the curtain. The Fed it's much more, it's kind of like the post office, right? It's just public government. And the people there, they're just, it's like post office employees trying to do the best. Maybe they don't know what the best is, just doing their best job. So I would expect the Fed to continue to make policy mistakes simply because, it's just a public organization trying to do the best it can. And it's actually quite simple. They try to be as transparent as possible. There's no grand conspiracy. There's no alternate intentions. They make an effort to be open, and I just think they're trying to do a good job, but they don't, just not very good at it.
Yeah. Well, that's really quite interesting that you say that, and you compare to the post office. I mean, most of us think of Jerome Powell and the Open Market Committee as, these have got to be the smartest guys in the room, right? As the saying goes by the Enron movie. There's a movie called that about Enron. These are the people that essentially run the global economy almost. I mean, they have more influence than any other central bank. Wow. Really, it's just mere mortals, huh?
That's what makes them so dangerous, right? They have so much power. It wasn't like this beforehand. There was a time in the past where our world was not so financialized and the Fed was not so concentrated. 100 years ago, actually, the central bank in DC, the Fed in DC, had very little power. Everything was run out of the New York Federal Reserve Bank of New York. They basically called the shots, but that's all different now. It's super centralized in DC, tremendous power because the world is so financialized. So when they make an error like they did last year, it affects all of us significantly. Again, when they did a good job like they did during March 2020 and saved the financial markets, that helped everyone. But when you make a mistake, it also affects everyone. So that's the risk with concentrated power.
Yeah. Do you agree with what they did during the COVID time? Like, was that intervention, was that justified? I mean, some real libertarian people believe they just shouldn't have done anything. Let the market work itself out, or during the Great Recession or the global financial crisis, whatever you want to call it. Was that right of the Fed to get involved and stimulate the economy and act like Keynesians? Or should they have just kind of let the economy take its medicine and it'll pass,
I think the way I think about this is just to look at the history of the Fed. Institutions exist for a reason. Now, when there was no Fed, what we would often see is that we would have banking panics. So a bunch of people would go to a bank, ask for their money back, and the bank, they had the money, but just not at the moment, right? It's a basic liquidity problem. And so the people would panic, they would withdraw their money, the bank would get in serious problems because they had to fire sell assets, then they would have solvency problems. So the Fed came into being to prevent those panics. People are emotional. Sometimes they get scared. And if you are able to provide, let's say, emergency liquidity, that calms the panics and everything goes back to normal. So that's how the Fed came into being in the past. And that's what they tried to do in March 2020. Emergency liquidity panic throughout the world. There's this weird sickness that we hear about on TV. Everyone's trying to get their money ASAP. So there was a liquidity problem, not just in the banks, but in the shadow banks as well. The Fed stepped in, provided lender of last resort, calmed everyone down, and everything went back to normal. If they didn't do that, then people would have to fire sell assets, take realized losses. There'd be bankruptcies and liquidations. I mean, if you work in real estate, a lot of valuation is actually confidence and sentiment. So stepping in helps it. But their policy error was, as you mentioned earlier, just staying in the market too long. So why were you buying all those mortgage-backed securities when, real estate was going up 20% a year? That doesn't make any sense, right? So they overstayed their welcome, but they did the right thing for being in the market in March 2020. That really saved a lot of damage to the economy.
Yeah, I agree. It should have been a very short-lived thing. And why were they still participating when values are going up 20% a year and, there's massive bidding wars on houses? It was just ridiculous. I know we've got to wrap it up, Joseph, but I just want to ask you about one more thing because you mentioned it a moment ago, the shadow banks. What does that mean?
Great question. So a shadow bank is a group of, let's say, businesses that act like a bank, but are not banks. So when I say act like a bank, what does a bank do? Bank has loans, asset loans on its balance sheet that are due in maybe in 5, 6, 7 years, but it has liabilities that are due immediately, like a deposit, right? So I can go to a bank and ask for my money back whenever I want. So a bank has a business model where they have shorter dated liabilities and longer dated assets. A shadow bank.
And by the way, before you move on, I just want to say to the listeners, remember, a bank looks at it the opposite of how we look at it. We look at a bank account as our asset, but it's their liability. We look at a loan as our liability. They look at it as their asset. So just to understand that, but go ahead on the shadow banks now.
Exactly. And a bank has access to a lot of emergency liquidity tools. For example, if suddenly there's a run on deposits, a lot of people go withdraw money from a bank. The bank can go to the Fed and ask for an emergency loan. So everything is fine. Now, there are a whole lot of other entities that basically have the same business model. For example, you can have, let's say, a mutual fund where you can invest in the mutual fund, and the mutual fund goes, it takes that money and it buys corporate bonds. If you think about it, it's a lot like a bank because the investor can go to that mutual fund and withdraw money anytime it wants. The mutual fund would have to sell the corporate bonds, long-dated assets to get the liquidity. A securities dealer is similar. A securities dealer borrows in the repo market overnight and uses that money to purchase 5-year treasuries. So you have a whole class of investment vehicles who behave with that bank-like structure. The difference being is that they don't have access to the Fed for emergency liquidity. So when something breaks, then they can't go to the Fed for emergency loan. They just have to fire sell assets to meet their liabilities. And well, sometimes that breaks things because when everyone fire sells, then prices go lower, more people have to fire sell, ends up in a deflationary spiral.
And would you use like long-term capital management as an example of this?
Yeah, absolutely. So long-term capital management funds itself in repo, basically, let's say overnight or 1-week loans, buys a whole bunch of longer dated foreign sovereign bonds. So classic shadow bank.
Yeah, that's a truly amazing story. Listeners and viewers, if you haven't looked up long-term capital management, this was the company that they thought they had the market figured out. Clearly they did not have it figured out.
When Genius Failed, this is a seminal book on it.
Right, exactly. Any outlook for the future you want to share before you go? You said interest rates look like they're going higher. That's going to bum a lot of people out. But overall, I think it's probably what needs to happen for the economy. Yeah. They need to at least get to the inflation rate, the official rate, to calm inflation and tame inflation. What about the stock market, precious metals, cryptocurrencies, that unemployment rates, the real estate market, whatever you want to share, just any thoughts you have on what's coming?
I'd be cautious with all financial assets. If you think back what happened in March, you had the Fed cutting, but not just the Fed. You had a coordinated central bank easing throughout the entire world.
Right.
Japan and Eurozone. So it's pretty easy. So when central banks coordinate throughout the world and they make easy money available and cut interest rates, asset prices go higher. I mean, that's exactly what we saw the past 2 years. Now they're doing the exact opposite. It's not just the Fed that is tightening monetary policy. It's the Canada, England, the European Central Bank. Bank of Japan, not yet, but eventually they'll cave. And when you do that, all asset prices have to come down in value. So that's what I'd be cautious for going forward. And this is basically the intention of policymakers.
Yeah.
Policymakers want people to have a little less money to spend. That's how they control inflation. There's too much demand. If you have everyone suddenly exploding in home equity and their 401ks, they're going to go and buy stuff, and that makes inflation worse. They're trying to reverse all of that. So you want to be very cautious if you're in any financial asset going forward.
Yeah. If you're in stocks right now, would you be selling your stocks?
So I own lots of oil and gas producing commodities, and I sell like tech and things like that. So that's what I do. I feel like there's going to be good areas in the market where it continue to grow based on the policy areas that the world is on in energy. But other than those, I don't hold any other stocks.
Yeah. Okay. So energy is...
I like energy a lot. Yeah.
Okay. Yeah. Interesting. Very good. Well, Joseph, give out your website. By the way, if you really want to take a deep dive into this stuff, folks, Joseph has an academic book entitled Central Banking 101, and it's in all the usual places. Of course, on Amazon, it has 261 reviews, which is pretty amazing for an academic book like that. Yeah.
Well, I try to make it more accessible. So if you're interested in my work, Central Banking 101 on Amazon.com, as Jason mentioned. I can also be found on Twitter, FedGuy12. And if you're more interested in more in-depth dive on timely market topics, check out my website, FedGuy.com.
Excellent. Joseph Wang, thank you so much for joining us.
Thanks for inviting me, Jason. It was a pleasure.
Jason, I just want to say this. Your presentation in Tampa was one of my favorites. I have been sharing that slide that I took a picture of with just about everybody I know about price of housing versus gold per ounce, and just incredible.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.